All right, good morning and welcome everyone to today's webinar. I am Jessica Cordero from Insightful Accountant and your host for today. Now, before we start, while everybody's kind of coming in and you guys are settling down in front of your computers, your phones, or your tablets, whatever you have in front of you, uh, yeah, as you know, we like to ask a question of the day. And for those already with us in the room, feel free to answer. Okay, so Mike, this is actually one of my favorite questions I've asked you so far. Okay.
Okay.
Okay, so the question is best sandwich ever. What is on it?
Oh, that's the Jimmy John's Italian sandwich, right? It's got the Italian sausage, it's got the lettuce, it's got the oil, it's got the spices, it's got, I don't think they put a cheese on there. They might put a cheese on there, but yeah, absolutely one of those Italian sandwiches from Jimmy John's.
I'm really hungry right now. I think that's when I wrote that question down. I was like, oh, okay, no, gotta ask this.
And Jersey Mike's got a competing one, right? So I mean, I think I'm a sub sandwich guy. When it comes right down to it, I like a great sub
I like
sandwich.
a sub too.
And
I
you know what's
agree.
funny? When I lived in the Midwest, I could go to any grocery store anytime and get a sub sandwich. They already had them made out and just laid there for you to pick up. I
Just
cannot find
ready.
that in Texas. Cannot find it in Texas. So I'm like going, something's wrong with the sub sandwich market here at the grocery store.
We gotta start it. You gotta start it.
There you go. Something's wrong.
Well, it's a missing piece, so I guess you could fill it if you want to.
Yeah, there you go. There you go.
All right. Yeah. Well, speaking of sandwiches, I'm hungry. But again, good morning, everyone. I hope you've had your breakfast. Welcome, everyone, to today's webinar. Again, I am Jessica Cordero from Insightful Accountant and your host for today. Now, in today's Cash Flow Mastery Talks, we'll be talking about capital expenditure decision making, maximizing returns on investments with the amazing Mike Milan. I will hand this off to Mike in just a little bit after I cover a few of the housekeeping items. As you guys know, this is just a 30-minute webinar, so there is no CPE for this. And if you have any questions, please enter them in the Q&A panel. And remember to be specific. You can't just say, hey, what you mean? You got to ask, hey, Mike, what you mean by you can't find any good sub sandwiches in your area, mainly because they might not get to your question right after you put it in there. Now, we will be sending you a copy of the slide deck and a link to the recording after the webinar. And it's also going to be up on our YouTube channel within about 24 hours. So if you want to go check that out over there, along with many other webinars that Mike has also done in the past with us that might be of interest to you. I'll be putting that link to our YouTube channel into our chat as well. And also do not forget that we have many webinars for you every month, whether you're interested in practice management, marketing, everything tax, or all things QuickBooks. Insightful Accountant's got something for you. And you can check out all of our webinars that are available to you over on our educational webinar page right on our site. And also, do not forget, since I know Scaling New Heights is coming up, don't forget to drop by Insightful Accountant's booth. So we're booth 0, where you'll get exciting announcements and exclusive perks for accountants, such as how you can enter to win a dream trip. So fantastic. Get travel tips from our Travel Spy podcast and find out about the year-round Top 100 Awards program. And you can come visit our booth and grab a free professional headshot. So for those of you who desperately need a headshot right away, come to our booth and Scaling New Heights. And lastly, the launch of our new Be Insightful membership designed to empower your firm's success. Now, lastly, if you have not subscribed to our newsletter, don't forget to join the tens of thousands of accounting professionals who rely on Insightful Accountant to keep them up to date on news and updates impacting today's accounting professional. Now, I will be rolling out all those links that I said I would and a copy of the slide deck throughout the webinar in case you might have missed it the first time. So you guys watch out for that in the chat. And Mike, that's actually it for me. Welcome and thanks for being here.
Hey, you know what? Great job as usual. I appreciate you. And live from San Antonio is Cash Flow Mike. So let's get in this. I'm telling you, this is one of the things I look forward to every month is coming and being part of the program here with the Insightful Accountant. We have a long relationship, goes back almost a decade now. So always good to come back to this group. So today we're going to talk about capital expenditures, like can I buy something? Should I buy something? When should I consider buying something? Those are the things that we're looking at, and it's based on a couple of different principles. So today what you're going to walk away with is 2 different things that you can do to make sure the timing is right for for you to make a purchase, because that's how you maximize the return on the investment, is making sure the timing is right of when you make this purchase decision. So people ask me, say, Mike, why do you do this, every month with an insightful accountant? And I'm telling you, it's because my mission, and I hope yours is the mission, that's why you're here today with me, is to eliminate cash flow as the reason that businesses fail. And I'm a firm believer that a lot of times it's just the way we communicate with our clients, or it's just the fact that we don't understand that there are simple ratios, techniques, things to look at that can keep us out of trouble, right? So I always like to tell people, I'm like going, hey, listen, have you ever crossed the street? And if you've ever crossed the street, what's the first thing you do? Well, you look both ways, right? And then I say, well, why do we look both ways? Just because our parents told us that all growing up? Normally it's not. It's because we're trying to avoid danger. And that's what some of my techniques in the Clear Path to Cash do. It helps you avoid danger. Imagine a bus is coming, but you see the bus is 3 blocks away. Well, if the bus is 3 blocks away, you got options to cross that street. You can walk, you can run, you could probably crawl, you could do a TikTok dance in the middle of the street and still make it across safely. But the closer that bus gets to you, the less options you have. And what I want you to have is the most options available to make the right decision and put more cash back into your clients' pockets. So that's what today's about. Not only this, we've done 12 of these already, or I guess this is number 11. There's 11 other recordings out there of simple, easy to use techniques that you can take to your practice today. So there we go. I have to start here. Right. I have to start, and you're going to go, Mike, you said that last week. I know it's that important. I'm going to say it again, because the silent killer of businesses is called mismatch financing. So when we're talking about capital expenditures, a lot of times we're also talking about debt underneath our breath, right? Because unless we're going to pay cash, we're going to have to use some type of long-term debt. This is the rule that keeps you out of trouble. This is the rule that's going to save you hundreds, if not thousands of dollars per year, because the rule is simple. The length of the loan should match the life of the asset. And what I mean by that is, if you can depreciate something for 5 or 7 years, then you use a 5 or 7 year term loan to be able to pay for it. And when I say that, it goes off in people's heads like going, oh, well, that's why they have a 5-year term. Oh, that's why they have a 7-year term. Yeah, it's because by the time your payments end, so does the depreciation expense. And it's a good time to think about replacement or upgrading or whatever you're going to do. So that's a matching principle. And then you might be asking yourself, well, why do I have to do that, right? Why is that so important? Well, because it forces you to use the right loan product. Mismatch financing is about using a short-term credit product like a credit card or a line of credit, something you got to pay off this year, for something that's supposed to generate revenue and profit for you for years to come, right? That's why we depreciate things. Well, if I use the wrong loan product, I'm paying too much money. What do you think is worth more and are not worth more? What do you think costs more? Long-term debt or short-term debt, right? Credit cards are around 25, 30% now. Mortgages are around 7 or 8, right? You wouldn't buy or use a credit card to pay for a house. That's the same thing we got going here. The length of the loan should match the life of the asset. I hammer on it. I talk about it. And if you can find it, right? If you see that your client's done this, you can be a hero immediately. Contact the bank and say, hey, we need to take this piece of equipment off of his credit card and convert that to a term loan. And when you do, you're going to save them hundreds, if not $1,000 a year in interest payments. It's a silent killer of businesses because it sucks money out of the company in the form of interest. Okay. So that's my preaching on debt. So let's figure out, when is the right time? Should I even be considering spending on a capital expenditure? And here's the ratio I use. You're like, oh, wow, it's a ratio, Mike. Well, we do. You got to remember, part of what my course is, part of what I try to do with you guys is turn ratios into actions, right? Think about that. Most people look at ratios, they look at it in a silo and they go, that's a number, and that's what do I do with the number next? Everybody's looking for what the action is. So what I do is I take the ratio and convert it to an action, give you a trigger point, a trigger decision point where you can determine, should I do this or should I not do this? So I use the sales to assets, and this works for all industries, right? Sales to assets works for all industries. If you notice, I'm using sales to total assets, not sales to fixed assets. Because if you use sales to fixed assets, it works better with an inventory-based company. It doesn't work as well with a service-based company. So you can actually use the same thing, sales to total asset or fixed assets, if you just want to deal with a manufacturing or an inventory-based company. But when I use this one, sales to total assets, it works for all companies, service or not, because all companies have some assets, even if it's AR, even if it's just cash in my bank account. There's some assets in every company. So I'm just going to throw some sample numbers out here. And basically what we're doing is how much revenue does my investment in a piece of equipment generate, right? That's what this answers, right? Instead of guessing about how much you can sell, this is telling you how much you should be able to sell. So if I take the number, we'll just use 8, these are millions. If you know me, I always drop off the zeros at the end. But it's 8.4 million divided by 4.3 million, 4.2 million. And that gives us the result. In this case, the result is 1.98. Yay, I got a 198, right? What does that mean? Most people are like, well, I don't know what those mean. I'm gonna share with you a secret about how to read any ratio that's out there. If you look at the way it's set up, sales is the numerator, total assets is the denominator. The denominator is always stated as a 1. So if I have $1 in assets, the result is always stated as the numerator. $1 in assets generates $1.98 in revenue. You see that? $1 in assets generates the result, $1.98 in sales revenue. That works for return on investment, works for debt to equity. Doesn't matter what ratio. That's how you read these things. And the way I say it is important because that's how your client's going to understand what you're talking about. So when they come to you and you say, hey, Mike, I'm going to get a new truck and I think it will give us an additional $1 million in sales. And they just guess and they put their thumb up in the wind. They go, yeah, that feels right, right? The wind's blowing that direction. It's probably $1 million in new revenue. Well, here's the thing. No, it probably won't generate $1 million in new revenue because the way you run your business, you only get $1.98 for every dollar you invest. So you invested 4.2 million and you're only generating 8.4 million in sales. So if you invest $100,000 in a new truck, Mr. Client, you're only going to generate about 198,000 in new revenue. See how that works? $100,000 truck becomes 198,000 in revenue. That's how you get your forecast a little bit closer to reality. That's where people aren't confused. If you've ever seen people like, oh man, we really suck, man, we can't hit our sales goals at all. Well, maybe it's because they didn't look at their sales to asset ratio and they're trying to hit $10 per dollar invested rather than $1.98. This helps you kind of dial in reality just a little bit closer. And what I like to do, I don't like to guess. I at least have a methodology. Is it always right? No, but that's the uncertainty of the future, is that sometimes it's not right. All it takes is one little thing. It's like the butterfly effect, right? One person sits on an invoice for an extra week and it throws off your whole cash flow forecast. But at least you have a methodology that gets you closer to the ballpark, closer than a guess, closer than this. All right, so what do I do with this? You got to know something about ratios too. Ratios don't mean anything unless you compare them to something else. They don't mean anything. So we have to compare it. And I always use the industry average. So in my products, I got a spreadsheet with it in. I got an app, the ClearPath to Cash app's got it in, industry averages. But I compare it like going, okay, we generate $1.98. They get a 2.3. Who's better here? I mean, throw it in chat if you know it. Is it C for the company? Is it I for the industry? Who do you think is better? The company or the industry? Anybody got a C or an I? Great. Okay. There's an I, C or an I industry. Pretty easy to see, right? There's a couple I's that came in. Pretty easy to see the fact that the company generates $1.98 for every dollar they invest, and the industry average is 2.3. So That means they generate $2.30. That's basically what it's saying. For every dollar you invest in capital expenditures, you're going to earn $2.30 in revenue. And you're like, okay, well, yeah, I always make my clients grade it. Do you think this is good, fair, or terrible? Well, most people will come up with the word fair. And the reason I do ratio analysis with those three words, good, fair, or terrible, is because now I can get you to focus on the ones that are terrible. In this case, it's probably fair. We could have improvement, but it's fair. Now, here's the other thing about this is that this doesn't mean you're actually terrible. This could be an opportunity. This could mean that you have the chance, the opportunity to sell more without buying another asset. You might already have enough sitting on the shelf, or you might have enough trucks in the lot, or enough forklifts and shelving and whatever it takes to run your business. You might already have enough. It could be used better, which means you don't have to go buy to sell more. In some cases, you do. Some cases, you have to actually go purchase another truck, purchase another line, buy another location, to be able to grow. Sometimes you have to do that because you've hit a capacity, you've hit a wall, like we've talked about, seeing things coming. Well, how do I know when that's true? I'm going to focus here on the industry average because if this is what everybody else is doing, then I should be able to do the same or better. So here it is. This is your goal line, 2.3. This is how you make the decision on should I spend on capital expenditure? Well, if your number is above 2.3, then maybe it's time to start thinking about adding for growth. If you're already generating 2.3 or higher, maybe 3, maybe 4, maybe $5 for dollar invested, you could be hitting a capacity. So once it passes this threshold, be watching for the point when you see stress. Like I have a plumbing truck and he can do 3 to 5 jobs per day. Well, I'm getting more demand than that. If I go sell, he's going to have to do 6 to 8 jobs per day. Can he do it? And that's when you start stressing out not only the equipment, you stress out the employees. It may be a good time to add another truck if you want to continue to grow, right? The capacity I'm talking about is like hitting the wall. In a service-based business, it's generally the number of jobs that you have going at once. When I was in a hotel staffing company, once I hit 15 employees working full time, every 15 employees, I had to add a supervisor because it was too hard for somebody to supervise. In a retail business, the golden rule is 3, right? Once you hit your third location, you're going to hit a wall. You're going to have to keep going past that. But 3 is kind of that hit the wall. It's the same thing for contractors. Once they have 3 jobs going at the same time, they're going to hit a wall and things are going to drop. When I say hit the wall, that's when you see stress in the quality, you see stress in your employees, you see equipment start to break because you're overusing it. Manufacturing and wholesale is all about space. They can only generate so many dollars per square foot. That's why you see all these type of calculations. You, for each client, have to determine what's your capacity level. So if it's like in my hotel staffing company, I knew that if I took on another contract and they had 15 employees that they were going to work on a regular basis, I need to also add a supervisor for that because I couldn't dump 15 more employees on the current supervisory team. So there's a point when you know you have to add. This kind of helps you understand that it's coming up. I'm already selling more than the average, for the amount of assets that I have. So maybe it's time to add. Well, if this is true, so's the opposite, right? The opposite's true that if I'm less, that means I have underutilized equipment. That means I actually have more room to sell. I've got enough stuff. I just need to go sell more. So this is how I make the decision on should we start talking about adding equipment or not. That's the first threshold. The second part of it is, can I do it, right? One is, should I do it? The second is, can I do it? And I have a course called, or a lesson called Forecasting by the Numbers. And forecasting in this case has 2 different parts. Step 1 is just doing what we all do. It's a pro forma income statement. But I can see that certain times of the year, I'm not going to be making any money, right? Which is, January through April, I lose money. Then I make all my money for the year, May through August, and then I lose again. So this is an example of how that works. But that's the first step. But you need this first step to be able to do step number two, to be able to answer the question, can I add CapEx for growth? And the second step is you have to build the cash budget. The cash budget and the pro forma income statement go hand in hand. The cash budget takes your plan. I'm going to sell $94,000 in January, but that doesn't mean I get $94,000 in January, because if I'm getting paid in 30 days, my 94,000 right here, 23 and 70, don't get paid until, well, February, right? It's 30 days later. I recognize the revenue in January. I get paid in February. Most people don't do the second step, so they don't see the connection between the sale and the accounts receivable, or the cost of goods sold expense and the accounts payable. They don't see that. What I ask people to do is consider it. Is it 30, 60, 90, and push your cash out to where it's actually going to come in. So how do I make a decision with this? Well, the way you work this spreadsheet, and I'll show you the spreadsheet here in a second. But the way you work this spreadsheet is not like the income statement. Most people run the income statement and says, "Oh, I'll do 94, 94, 126, one." They'll run it horizontally. They'll just fill in the gaps or the blanks horizontally. The cash budget can't be worked that way, because you need to do it like a snake. You come from January, you got all the cash in, right? So all cash inflows are added up for January. Then all the cash outflows are added up for January, and it gives you a cash balance at the end. That's just a basic forecast. Now, I built cash flow tool. I know that forecasts can get a lot more complicated than this, but this is a quick, easy way to be able to see the bus coming at least a month in advance. Maybe not a day in advance, maybe not a week in advance, but a month in advance. And sometimes that's good enough. That's at least starting the process where I'm not wasting a lot of time focusing in on every little transaction like I used to. I'm now looking for the big picture. When is my big problem coming up? So January comes down. Now the ending cash balance, right, for January becomes the beginning cash balance in most cases for February, right? In this case, what you're not seeing is that I borrowed to get to 625, because I don't like my clients to actually carry a negative balance into the next month, right? You got to have some money to go to the next month. This is how we determine how much we should take out on a loan. So let me just show you the spreadsheet, because it makes a lot more sense. Sure. Spreadsheet. There we go. Yeah, I think you can see the spreadsheet now. Okay, so this is the top portion, right? And basically what I have people do is fill in just the annual, and then we look for seasonality. And I've got a seasonality calculator down at the bottom that helps you determine about how much of your revenue comes in per month, and it gives you your average to be able to plan for the next year. And I use like a 3-year average to get there. But on the next step, step 3 is the cash budget. So in the cash budget, I can actually change from 30 maybe to 60 days, and watch the credit sales line. Cash sales are going to come in as they come in, right? That's why I could split them up. But credit sales, you see how I moved it out 60 days? If I moved it out even farther to 180 days, it moves it. It's actually taking the reality of your business. When is that check or that cash going to hit my bank account, and it spreads it out to the right time frame. So that's the cash in. Cash out, same way. I could do the same thing with accounts payable, which is I can spread those out, and it moves and recalculates for you. So in this case, let's just say that I have accounts payable, cash outflow, cash balance. And you see that I borrowed. I borrowed to cover the $34,000 I was short. But here's where you're talking about, when should I make the purchase? I'm already projecting that I'm not going to have enough money January, February, March, April, May, and I have to borrow. Well, I don't want to create a bigger problem in the company by also making a vehicle purchase with cash, or I add long-term debt payments here where I've got to now make payments on this. It has to be included in the budget. You don't see long-term debt payments on the income statement. Why? Because those payments are made with what they call net profit, retained earnings. Your EBITDA determines how much you can afford, but that's where they're calculating the payments from. You're going to use net profit to make your term loan payments. That's why you have to do the second step with the cash budget. But here's where you can have a discussion. You're like, oh, hey, listen, I know you want the truck, but it's still kind of working. Do you think we can limp along and maybe get it in, what is it, January, February, March, April, May, get it in May or June when we'll have more money. If we get it in May or June, we're going to hit your busy time where you'll have a new truck to be able to go into your busy time. But B, we're not creating additional stress on the company during some months where we're already going to be short. We can see already that the first part of the year is going to be bad, and then we'll actually catch up as the busy season kicks in. So from here, I just kind of play with it. If I want a new piece of equipment, maybe I shouldn't get it in May. Maybe I should get it out here in June or July, right? And delete that. And look, just moving that purchase, that new piece of equipment, 1 month, 2 month, might be the thing that saves your client from a big hassle and stress of not being able to make payroll. So that's kind of what I do. And like I said, if we need a new truck, we could spread things out. I also use this to determine if I can borrow from a line of credit, a short-term loan, and pay it back. So in this case, you can see that I borrowed 35,000 to cover that shortage. I borrowed 62,000 to cover that shortage. I borrowed 115 to cover that, but I'm using it to run the business. And at the same time, I'm also keeping a cumulative total. So in the end, I've borrowed $254,000, but once the busy season kicks in, I can pay it back, which is what's going to make you look the best in front of a banker. If you can show them that, yes, I'm going to draw from the line the first half of the year, but here's my plan to pay it back. And I should be able to not only pay it back, but not draw on it for the rest of the year. I don't see very many accountants or advisors or people like that working with their clients to determine when's the right time and proper time to use a line of credit and when is the right time to pay it back, because you need to pay it to zero and let it rest at least one time a year, 30 days. That makes you perfect in the eyes of the bank. Okay, back to the other. Okay, share. All right. I think you see that. Okay, so we're coming up on the end. Got about 2 minutes left. I've always tried to kind of match it to where I don't waste your time. But if you want, I do have a free copy of my digital book, The 7-Minute Conversation: How to Analyze Any Business in 7 Minutes or Less. The thing that's really popular right now, we had like 80 people in the last 3 weeks join our Clear Path to Cash group. Matter of fact, there's a 32-page PDF on forecasting that's free inside this group. So join the Clear Path to Cash, finding hidden business or hidden cash in your business. Join that, and you can get the forecasting by the numbers PDF for free out in the book. I do have a podcast. If you like listening to stories and things about business, beer, BS, those type of things, Blaine Birch of Dry Run and I have a podcast. Go check that out. I mean, we're at episode 146, season 4. So this has been going on for quite a while. And then lastly, if you have anything that you want to talk about, what I've talked about today, you need clarification, you need help, contact me at mike@cashflowmike.com, and happy to jump on a call and help you, with anything that I might have said you had confusion on. So, Jessica, I appreciate you. Thank you very much.
Thanks so much. A minute to spare, Mike. All right. Well, thanks, Mike, and everyone for taking time out of your day to hang out with us. And right before we close out this webinar, remember that we have a variety of webinars for you every month, and you can check those out on our site with the link I sent. And also don't forget to check out and subscribe to our YouTube channel where you can find this webinar recording and newsletter as well, so you don't miss out on news and updates that impact today's accounting professional. All right. Well, thanks for today, everyone. And we'll see you in next month's Cash Flow Mastery Talks with Cash Flow Mike. See you, everybody. Have a good day.
Appreciate you.